Hey everybody, welcome to this week's NASDAQ Dorsey Wright podcast. This is Will here. We have a special guest. Matt, I'm going to let you introduce yourself first time on the podcast, but hopefully not the last.
Thanks, Will. I think guest is just fine. We don't have to say special.
Okay.
So I'm the head of ETFs at Calamos. Calamos, for those of you who aren't familiar, has been around since the late 70s, was started on the premise of convertible bonds. So Calamos is the largest convertible bond manager in the country. We're also one of the largest alternatives fund managers in the country, largely based on our market neutral income fund. It's about a $15 billion market neutral fund. And then we also are a very large user of options. I believe we're one of, if not the largest user of S&P 500 index options in the country as well. So a few bullets about Calamos. And we've been around for a long time, and we've been growing into this options-based space, as we started our ETF line. And so we're excited to talk about that today.
Yeah, I think there's so much to talk about there, and obviously the firm's been around for a long time, so it's been through plenty of market cycles, here to stay, and have people to talk about the evolution of the products. The I I titled it Passion Projects when I sent you over the outline before the podcast.
Sure.
You all have a capital protection suite, and we'll loop this kind of high level for our clients and the listeners. There's a capital protection suite, which I think we can get more detailed about, but there's also been these buffered funds that have been coming out for a while as of late. The past few years, they've been racking up assets. And for those not familiar, some are called targeted outcome, but the idea essentially is you're buffered on the downside, and then you're participating in the market to some type of upside cap, and they're using options to do it with it in the products. People have loved these. It's behavioral finance all over it, but you guys are doing something a little bit different. And I was gonna let you kick off with the capital protection, and like maybe how that differs from most buffered products out there right now.
Yeah, the capital protection ETFs are slightly different. I'd say they're a new iteration of that buffer ETF type strategy. A lot of it is based in some history, and so just to give you a little bit of that, I started my career at PowerShares ETFs, building out smart beta ETF space there. After PowerShares was sold to Invesco, a lot of the partners retired, and I moved to an actuarial consulting firm. Milliman was the name of that firm. I went over to help build funds based off of the risk management strategies that Milliman was doing on the balance sheets of life insurance companies. And so we saw a lot of need inside the life insurance world for risk management. We had moved some of those hedging strategies into the sub-accounts of variable annuities. That business grew very well. We built about 55 funds over a short time period. We also built some index strategies. But what we saw in that really low rate environment was the value proposition that life insurance companies and even banks to some extent on their structured products could offer was very low because rates were low. And so if you look at fixed index annuities, or even if you're a just normal investor looking at CD rates, you could think of the rate you could get on your CD at that time, around 2010 or so, was very low. And so it really caused the insurance marketplace to move from this fully guaranteed principal protected world into a risk sharing model where instead of giving 100% protection, now we could give you, a 10% protection level or 20%. So you move off of that 100% protection level, give somebody a buffer, and then the upside that you could deliver was better than if you were to deliver 100% protection. So it was largely rate driven. What we found at Milliman was around 2016, was that you could deliver that type of approach, that buffer and a cap relative to the S&P 500 or some other market, the NASDAQ 100. You could deliver that very efficiently with options contracts. And so we developed some intellectual property to deliver a buffer and a cap on a broad market like the NASDAQ 100 over a 1-year outcome period. And that IP really set the stage for the buffered ETFs, some call them defined outcome or target outcome ETFs that are in the market today. That space launched in 2018. It's grown significantly since then. We've seen a lot of folks latch onto that type of opportunity to get really measurable upside, again, to a cap. There's no free lunch there, but then a buffer on the downside. So you fast forward to where we are today, rates are obviously much higher than they were then, off of zero. And so because rates have moved higher, those principal protected strategies are back again. I saw an article 2022 that said capital protection is back with a bang. There's, people are buying CDs again. They're buying money market funds. They're buying principal protected structured notes and fixed index annuities. And so this is a very similar play on that same type of approach, delivering 100% protection relative to a reference asset like the NASDAQ 100, and then having a capped upside. So on May 1st, we launched our first capital protected product, the Calamos Structured Alt Protection ETF. It was on the S&P 500. The raise up went very well. The opportunity set there was strong, about a 9.8% cap. And then June 3rd, we launched the NASDAQ 100 version, which had a little bit higher cap than that even because the volatility is a little higher. And then July 1st, we're launching again S&P 500 and then a Russell 2000 version. We're on file with those two. We're seeing even higher cap with the Russell because the volatility and the dividend yield are a little bit higher there. So again, it's not a marketing gimmick. You can actually deliver 100% protection over a 1-year time frame with the underlying reference asset there. And so it's been a value proposition that we're seeing take off right now.
That's incredible. I mean, it definitely sounds too good to be true. And especially now with markets, at least S&P 500, NASDAQ near all-time highs, tons of people that we talk to, our clients, are like, we're scared to put money into work right now. What if we get a 5% drawdown, 10% drawdown, especially for clients that have larger pools of money coming in? That dollar cost average maybe isn't sure that could be the right approach, but there's a bigger element of cash coming into the market. So there's that entry risk. So something like this, I could see making sense as a way to kind of step your way in to the market with the downside protection. And you kind of alluded to this earlier with the use of derivatives, but at a high level, if someone were to say, this is too good to be true, what's the catch? What would be your kind of take on that?
Yeah, so maybe we'll go into the derivatives, and then if people are still with us, we can go back and talk about the application.
High level, yeah.
So one thing that we'll do is just pretend like I give you, Will, $100, and we can recreate this package. And so if I gave you $100, the first layer we're going to buy, it's 3 layers of options. The first layer is a participation layer. It's called a zero strike call, or a really deep in the money call. And that's going to take most of your budget. That's going to cost around $98. And that gives you the full upside and downside of, we'll use NASDAQ 100 in this example, over that 1-year outcome period. The next layer is we're going to buy an at the money put, and that's going to cost around $4, let's say. So we've spent $98 on our participation. We've spent $4 on our protection layer. And so if you've been following along, we've now busted our budget. We've spent $102. So what we do next is we sell an out of the money call, at a strike price that we need to in order to generate $2 worth of premium in order to bring that budget back in line with $100. So that package all works together in order to deliver that 100% protection over a 1-year outcome period. And whatever the strike price is that we had to sell that call option at determines your upside cap. So for the NASDAQ 100, when we launched in June, it was just over 10%.
That is a very succinct explanation. I think most of our clients are definitely going to follow that.
Good. Okay, great.
Yeah, that was good. Now, I'd be curious too if you have thoughts like what has, because I haven't seen these come out very often. I've seen a lot of the buffered series. What maybe has taken these a bit longer to come, at least to the ETF wrapper? I'm talking specifically because you don't see a lot of 100% downside protection, upside participation. It's typically the buffered on both end.
Sure. A lot of it has been rate driven. So as I was saying before, we brought the buffer ETFs out at a time when that was the best trade, in my opinion, at the time. You couldn't deliver 100% protection when rates were at 0. But now that rates are off of 0, we can deliver 100% protection again. I'd say a rough back of the envelope thing to consider would be where we can deliver about twice the risk-free rate, a 1-year risk-free rate. So if rates are at 5%, you see caps between 9 to 11% right now, based on the underlying reference asset that we're using. So even if rates come back down and settle, around historic averages, let's say 3.5%, then you can do the math and say, okay, my cap's going to be, maybe between 6 and 8%, something along those lines. Which, if you go into the application part, Your opportunity set then, we see basically two sides of a coin. We see people using this as a cash alternative. If you were to go out to the market, buy a CD or a bond, or even a structured product, those will all mature. And at the end of that maturity, you will be paying ordinary income tax rates on that. So if you got a CD and that paid you 5%, at the end of the year, if you're in the highest tax bracket, that 5% will turn into about, 3%, let's say.
That's right. Yeah.
So this product, this ETF, then will give you the opportunity to turn in that 3% guaranteed rate that you would get after tax and get the upside opportunity of 10% relative to the NASDAQ 100. And then that money stays in the fund as long as you own the ETF. It just continues to compound year over year, tax deferred. And because it's an ETF and an equity ETF, then when you go to sell it, if you've held it for longer than 1 year, you pay long-term capital gains rates on that ETF, on that sale. And so there's a big tax alpha that can be had by taking that 3% guarantee and turning it into upside opportunity. And then, to be fair and balanced, your opportunity cost is that 3% that you may have otherwise gotten guaranteed.
Sure. Wow, that makes sense. Very cool. Because I've had concerns, I guess, with some other products. I don't know if this actually ever happened, but maybe some products would like liquidate at the end of a year. I know maybe some early versions, maybe not, of course, not this one in particular, but that makes sense. It's kind of, I guess, the legs reset at the end of a year. Is that
So the
appropriate to say?
ETF will stay open, and then the
Right.
options positions reset, in this case, every year. So we use flex options, which are exchange listed options. Here we do this on equity ETFs. So on, the QQQ, for example, and we can make those expiration dates all align and then customize our strike prices so that we can get that efficient tax treatment and then deliver all of that, at the end of the year, and then roll into a new set of options. So the ETF will stay open. The only thing that will reset is your protection level and your cap rate.
Very neat. When we were chatting the other day before the podcast, you also brought up this great idea of it can be these types of strategies are fit for investors that are in an accumulation phase and also those in a what you consider like a decumulation. Is that what you said?
Yeah, that's right. That's right.
Because of the protection. And I think that's a point to speak on one, but also I would say, where like someone's risk appetite, I guess would this take someone who's typically a very conservative or even moderate investor and even like maybe potentially bump them up the risk spectrum? Not actually, but in terms of willingness to bear some risk.
I think for an accumulating investor, you have that cash alternative. You also have a bond alternative potentially. We also see some folks who are just looking to de-risk their equity exposure. Then they would just put a portion of their assets into a capital protection strategy. And then you can essentially create this downside exposure that you're looking for. With buffer ETFs, those are designed to deliver a very set, hard protection level or buffer level. Here, you can kind of choose how much you want to allocate and then build your own risk management process there. And so we see the accumulating investors use this for de-risking their equity exposure to some regard. And then the decumulating investor, I would say, or just simply put, the retiree, as you're entering that retirement risk zone, on that front, we're seeing a tremendous number of people reaching that peak retirement age. It's around 11,000 per day between 2024 and 2027. I think some research by the Alliance for Lifetime Income has come up with that. So we've seen this massive swath of people entering retirement, more than has ever occurred in U.S. history, and they're facing three financial risks as they retire. There's longevity risk, with people living longer, their retirement savings have to stretch further. And then there's inflation, which people didn't really have to account for, over the last 15 years, but suddenly it's here again. And so over time, those prices for goods and services tend to rise. Your purchasing power tends to fall. And so being in the stock market is a great, hedge to inflation. But oftentimes retirees, not just behaviorally, but mathematically, can't afford all of that volatility. And that I would say volatility is the third risk there. The unprecedented nature of market volatility in the financial markets can really cause significant portfolio losses. And if you're withdrawing from your portfolio while you have volatility. It's not just a behavioral problem, it's a mathematical problem that could put
Yeah.
you on a trajectory, down to zero, or you have to reduce your spending significantly in order to make up for that. And so using these types of structured protection ETFs can really help you solve those risks. So you have downside protection, which helps portfolio longevity. You have growth potential. You can tie your equity to the stock market or tie your cash to the stock market and outpace inflation. And then there's liquidity and flexibility there as well. So if you need your money, at any point in time, maybe there's a healthcare event, something like that, then you have access to that money anytime the market's open.
Yeah. It's pretty compelling, especially when you think about, I know I talk with our clients as well because we have our own models, our own products that people use. And we've been attending conferences lately, people talking about sequencing risk or return sequencing.
Sure.
And this is an important aspect to that, to maybe at a high level smooth some of the risks of return sequencing, where you get a bad stretch of years and someone's 75 years old, they can't go out on the risk spectrum enough to remake some of those gains.
That's exactly right. Yeah, the sequence of returns risk is real for a retiree. If you're entering retirement and you have a big drawdown year really early on in your retirement, it,
Yeah.
it sets you up for a difficult path going forward. So this helps a lot with that.
Yeah. Now, I know you all don't just do the capital protection. I just said you all have been around for 50 years, well versed in many areas of capital markets.
Yeah.
You mentioned, I think you alluded to before, equity, fixed income pairing in products as
Yeah.
well. I don't remember the exact specifics of it, but you can
You're thinking
jog
of
my memory on that.
CanQ, I think, CANQ. It's our
Yeah.
alternative NASDAQ and bond ETF. If I did it over, I probably would have built that after capital protection. Because in my
Oh,
mind,
yeah.
if you can understand, hard protection level, then you can understand a bond floor. And so that's what we've done with CanQ. Instead of a, explicit equity protection level, here we're holding 90% in an actively managed portfolio of fixed income ETFs. Matt Freund is our portfolio manager on that fixed income side. He's co-CIO at Calamos. And then we take 10% of that portfolio and we buy laddered call options on stocks in the NASDAQ 100. And so you get all that upside, uncapped upside growth to stocks in the NASDAQ 100. And then if the market's in a severe sustained drawdown, those calls may expire worthless, but you have 90% in a fixed income portfolio. So as we're at a 5% interest rate environment now, if we do hit that severe sustained market environment, like what's likely to happen? Rates may start coming back down. That bond portfolio may appreciate, and will help ballast that product and help be a bond floor for you there. So I love that concept.
Yeah.
And again, I probably would have built it second, which I'm glad we're talking about it second, because if you can understand a hard protection level, then you can understand a bond floor.
That's really neat. I like hearing product ideas like this that people have actually put out in the market and there's real money behind it
Yeah,
versus just, theories on spreadsheets. But
that's right.
these are real products in the market. There's real research behind them. Great for idea generation. I know our clients were always talking about portfolios and like efficient ways to use capital. I think this is a great way to talk about that. I mean, derivatives are a huge portion of that where you're getting the exposure for putting up less money. And then you're getting the exposure, and then with what I would say, the rest of the money that you would have spent, you can go buy protection in bonds or go buy protection in
That's right.
something else. So yeah, it's a great lesson on like capital efficiency and asset pairing and so many other
Yeah.
things. So no,
And there's
really
some,
cool idea.
yeah, say there's some trade ideas where you'd hold treasuries and then buy call options and tie it to that. Here we're taking on a little bit of credit, a little bit of duration risk. And so we think the timing is right for something like that. So you can get this 90% active bond portfolio and then having 10% tied into the options. To bring it full circle, it's a little bit like a convertible bond where you've got, this bond floor and a call option attached to it. What I like is that most, if not all, of the stocks that we're writing calls on don't have convertible bonds in the market. And so this is a way to give you almost synthetic convertible like exposure for people who are familiar with the convertible bond. But the simple story is it's a 90% bond portfolio with 10% tied to calls.
Yeah, fascinating. Well, cool. I don't want to keep us too long. We're probably getting near our our range for podcasts. Any parting shots from you about the space, kind of what you expect going forward, things to look at?
Yeah, this is all, obviously a lot of fun for us. We enjoy, building active ETFs. Calamos is going to be around for a long time. The future is bright here. So I would leave it at that. I think there's a
Cool.
lot to keep building, and appreciate the time.
Yeah. If they want to get in touch with you, where's the best way?
Yeah, you can go to calamos.com. You'll see all of our ETF offerings there, and I'm always up for a good conversation. So feel free to shoot me an email personally too. That's fine. Actually,
Yeah,
send it
Matt.
to my work account though, not my personal account.
Yeah, right, right. No, Matt, I've enjoyed getting to chat with you the past few times. Thank you for coming on, sharing your insights, sharing some really neat product ideas. Everybody else, thank you for listening this week. We will be on next week.